No, as you said, my brain is already spinning about a client that I need to call right now. When they pull the trigger, do they own it or does the trust own it?
Great question. They own it within a JV partnership with the trust. And this is how we get the new depreciation schedule. So follow me here, Leigh. Let's imagine you own a $10 million multifamily property for the last 27 and a half years, so you're fully depreciated. Remember, depreciation is the number one reason, one of the number one reasons to own real estate, because it offsets the income that's coming in. Okay, but as soon as you run out of that depreciation, that's not so good. So if you do a 1031 exchange, guess what? That depreciation schedule travels, which is not good. But if you buy that same property through the trust by doing a JV partnership with the trust, you get a brand new depreciation schedule.
Oh,
so this is
for real?
really how this works. Okay, so you
That's
sold the property.
huge.
Yes. You sold the property for $10 million, right? And your brain will be turning all night because once you learn about this is what we do every single day. You sell, okay, and the proceeds go into the trust. And let's imagine you would have paid $4 million in tax, but instead you didn't. You did a deferred sales trust, so 10 is sitting there. The next day, or let's say day 181, or again, a couple of years from now, when you find the perfect deal, we like to say the deal that hits you over the head, right? It just hits you over the head, and you would be stupid not to take the deal. Like, wait for that buyer's market or that opportunity or that distressed seller. That is optimal timing on your terms, okay? So it hits you over the head. What do? Well, you've been sitting in very conservative securities. I mean, very conservative stuff where you're not dropping by 30%, and you're just waiting. And then what do? You form an LLC, Leigh. You're the managing member of the LLC, and you actually partner with the trust. And let's just say $8 million, because that's what's available. The other $2 million needs to stay there, goes into the LLC. Now you're running that deal the same way you would have. The only difference is the trust put up 100% of the down payment, but you, Leigh, are 80% owner of that LLC. Why is that? Well, you're doing the sweat equity. You're finding the deal. You're managing the deal. You're doing everything. This trust is just a silent partner. Okay. Now it does have a preferred return. Okay, and it does get 20% of the upside. It's commercially reasonable with the IRS. Okay, this is why we have the 80-20. This is why we have the preferred return. We mirror the note, 8% for that preferred return. But let's fast forward. That $10 million deal is now worth, let's say, $5 million. 5 years from now, what do? Well, you got to pay back the original down payment that the trust put up. You got to pay back the original preferred return, and then you got to pay back 20% of that $5 million. But guess what, Leigh? You put up zero down payment yourself, but you get 80% of that upside. Okay? What can you do at that point? Well, you can roll that all into the trust, and you have one trust and you have multiple notes. This is the neat part too. You can slowly sell individual assets and just roll it and consolidate into one deal. So I'll pause there because I said a whole lot, and you might have some questions.
No, as you said, my brain is already spinning about a client that I need to call right now and make an introduction so that he and his wife can look at this as an option, because the idea that you can reset your depreciation and be able to continue growing your money is huge. And